Sustainable investment managers do not trade performance for impact, and there have been a number of studies showing that, including the CFA Institute and Morningstar. It's a lot more difficult to tie that to a performance number. Clearly there's an economic benefit. It's very impactful, but I do think that there's probably a bit of a trade-off on performance for very, very impactful type of strategies. On the public equity side, however, we really see ESG integration and investing in companies that are creating positive impact as a source of alpha. It's both intuitive and logical to us that companies that are creating positive impact increase in value over time. Likewise, companies that have very strong negative externalities, like oil companies, are not sustainable investments over time. Therefore, if you're looking to be a long-term investor, we think it's a little bit foolish for investors not to be considering the impact that the companies they're investing in are creating. So we think that we can have impact through investment in public equities, and there's a lot of different ways to measure that. When you're investing in a small company, for example, you're providing them with a stable capital base, which allows them to fund and grow their business over time. For larger equities, the link is a little bit less clear, but we're looking at companies that are working towards one or more of the Sustainable Development Goals and looking at our portfolio and which percent of those are working towards positive achievement of those Sustainable Development Goals as a measure of companies that are creating impact. We're also engaging and advocating with the companies that we're investing in, really identifying material sources of weakness in their ESG policies and procedures and asking them to address that. When we have success there, we're clearly creating positive impact. So here are a few examples of how ESG integration adds value in the investment process. Back before 2015, we took a look at a company called Volkswagen, which obviously is well known. What we found is that we had some serious concerns about their governance. So only 25% of their audit committee was independent. They had non-independent remuneration and nomination committees. They hadn't articulated a long-term strategy, and there were some other ethical questions we had about the company. We really saw it as a risky culture at Volkswagen, so we decided not to invest in that company. Clearly, we had no idea that they were going to go and lie about their diesel emissions tests, but by understanding the culture of the company a little bit better, by having that extra valuable source of non-financial information, we were able to avoid adding that risk to the portfolio. Another example of that is Tokyo Electric Power, which was responsible for Fukushima. So what we saw when we looked at the company and where their power plant was, which was an earthquake zone, we really felt they should have the safest of procedures. Instead, they had some of the riskiest. So it was a stock that we avoided and clearly had very catastrophic effects. So one company that we think has a really sustainable product and has performed quite well since we've held it is Ørsted, which is an offshore wind turbine utility. The company used to be known as Danish Oil and Natural Gas, and they decided several years ago to convert entirely to offshore wind. So because of their size, they have a large scale advantage, which gives them a cost advantage when bidding on these projects. I've met with management a couple of times, and they're very return on invested capital focused, so they're not going out there and bidding on projects that they don't think they're going to make money on. We see wind and offshore wind as a solution for the energy transition the world has to go through as we address climate change, and Ørsted is clearly one of the solution providers for this transition. The philosophy behind Mirova's global sustainable equity strategy is that the market is undervaluing the long-term growth trends that are going to come from these transitions the world has to undergo as long-term secular trends around demographics, technology, the environment, and governance play out. We also believe that the market undervalues risks around ESG and the companies that are not implementing policies and procedures to adequately address their ESG risks. So our whole investment process is designed to exploit these market inefficiencies and create a portfolio that outperforms the broader market and does so holding stocks that create positive social and environmental impact.